Let's get the read from Mitch Rochelle back with us, Macro Trends Advisors. Also, Aaron Gibbs, the Main Street Asset Management CIO. Aaron, ended with you, then begin with you on what these three gentlemen were saying. Not much faith in the Federal Reserve. They don't want to rattle the markets. Might be too late for that, but not fans. What do you think?
Well, I mean, there's certainly an argument. When you look at when the Fed releases their projections, right. When they look at their future expected inflationary and expected unemployment.
And they're going to do that today.
And they're going to do that, well, and hopefully in the press conference, but we won't get the actual notes for 2 weeks. But this is that quarterly summary where we get those projections. They have been severely wrong and severely revising those projections from March to June, and we expect probably another big revision coming for September. So I agree that they've been really wrong about where we're going. They've been very late in the game, and there is a real risk. And as Mitch had mentioned, we are in a technical recession already. We've already had 2 quarters of GDP contraction, and so I think it's a very real risk. And I think right now it's much more likely that we will end up with some period of pain versus being able to thread the needle, as the statement, as everybody likes to say, and come out of this smoothly.
Yeah, Mitch, I was talking to an economist who was critical of President Biden, sort of dismissing the inflation threat, also saying that we're not in a recession. And he said, well, if the American people are telling you we're in a recession, guess what? We're in a recession. And your words are hardly helping. Having said that, where do you think all these hikes are taking us? Because we've yet to see them get a handle on the inflation that they're supposedly addressing yet. So where are we going?
Yeah, to pile on to Aaron's point, they started by saying that this was transitory, and it wasn't just the Fed. It was also former chairwoman, now Treasury Secretary Yellen. It's transitory. It's transitory. That is a head in the sand strategy, if I've ever seen one. So what are you trying to do by raising interest rates? You're increasing the cost of credit that Ray Dalio referred to, but you're trying to choke off the demand side of the economy. And it's strange because the demand side of the economy is sort of dealing with this to some degree. Right? You and I have said this over and over again. The only cure for inflation is inflation itself. It gets to the point where consumers just go Roberto Duran and say, no mas, that's it, I'm not paying that price anymore. But they're pretty resilient, right? In certain segments of the economy are shaking this off like it's nothing, which means if the Fed wants to do its job all by itself, what choice do they have? They're going to have to continue to raise rates and try to grind down the demand side of the economy. So it's really unclear. Soft landing, threading the needle, all of those things, I think it's virtually impossible to do that because it's counterintuitive. If you try to choke off the demand side of the economy, which is the consumer, in an economy that's driven by the consumer, by raising interest rates, how in the world can you do that softly? It just doesn't make any sense to me, especially when we've done, 3 consecutive raises of 75 basis points, 3/4 of a point, right? But the bond market is sending a message that this is going to go on for a while, I think.
Thank you for the Roberto Duran reference, even though you and I were the only ones who got
I watched that fight. I actually watched that fight.
I just decided that's it, I'm done. Aaron, I would be curious. So you mentioned something interesting about how high you would have to go, to sort of get this under control. And the argument is you want to get, if your goal is to get back to 2% inflation, or that they're looking at that, we're 8.5% or something like that. So would you have to go to 8.5% to get it down, or do you hope that the rate hikes that you're seeing eventually bring that down so you don't have to go that far?
Right. That's the idea, is that you basically meet in the middle. Inflation comes down and your hikes come up.
But there's a significant delay, right?
Yes. And so one of the problems is that these hikes often aren't forecasted to really take effect for another 9 to 12 months. And so that's part of the difficulty in the Fed is that
could be up to next March before we see any
and
there's the risk of overdoing it.
Exactly. And then on top of it, we do have additional government spending, which is adding about another $1 trillion worth of treasuries out there. So between quantitative tightening, which is about $500 billion, and then another $1 trillion through the government, there's a lot.
Well, that's interesting. So all the tapering to get trillions off your books, you're putting trillions back on.
Exactly. And so it's about 3 times the rate of 3 times the amount of treasuries are on the market than they were pre-COVID. So there are a lot of bonds out there for sale, pushing obviously rates even higher if we push those prices down.
Because that would cheapen them and lift the yields. How high do they go?
Well, right now, look at the, Aaron and I were talking about this in the green room. The one-year Treasury is 4.05, okay? Wow. That's the one-year Treasury. So it gets to a point, and by the way, go to a bank and they're still giving like 45 basis points for a certificate of deposit. But it gets to a point where investors start saying, wait a second, this is starting to look pretty attractive. I don't know what the next year is going to hold, but if I could put money in and guarantee that I get 4% for a year, that's pretty compelling. And the other thing is money market funds became really, really popular. We're going to date ourselves again, Neil, but I remember when like you were getting like 16% in a money market fund.
Absolutely.
You were crazy not to throw everything you could because money was doubling very quickly. If the short end of the curve starts going wild like that as a result, I think it just completely starts to change investor behavior.
Mitch, final word. Ern, I want to thank you very much. By the way, some of these bankers were questioned on those paltry savings account yields, saying they could easily go up another third of a point. It was very reassuring. All right, now we'll hear from the Federal Reserve, Charles Payne, to take you through that as Fox Business continues.